I've always wondered how banks work. Like, do they just lend out the money that people deposit with them?
You'd think that's how it works, but it's actually a bit more complex. In fact, banks can create new money when they issue loans. It's not just about taking money from one person and giving it to another.
Wait, they create money? How does that work?
Well, it's not like they print new bills or mint new coins. They create money by issuing loans. When you sign a loan agreement, you're promising to repay that amount with interest. The bank then credits your account with the loan amount, even though it's not necessarily backed by actual deposits.
That's wild. It sounds like banks can just make money appear out of thin air. How did this start?
There's a great story called The Goldsmith's Tale that explains how this system evolved. It's about a goldsmith who noticed that people rarely came to withdraw their gold from his vault, so he started lending out more than he actually had in reserve. Would you like to hear it?
Yeah, I'm curious now. How did that lead to modern banking?
So the story goes like this. Once upon a time, in a bustling town, there lived a goldsmith who was known for his craftsmanship in making gold coins and jewelry. Because gold was a valuable commodity, he built a secure vault to protect his treasures. As word spread about his vault's safety, other townspeople began to approach him, asking if they could store their gold and valuables there for a fee. The goldsmith agreed, and soon he was renting out space in his vault, earning a steady income from this side business. In exchange for storing their valuables, the goldsmith issued claim checks, paper receipts that served as proof of ownership. As this system became popular, the townspeople discovered that these claim checks could be used in the marketplace like money. Instead of lugging heavy bags of gold coins, they could trade the paper receipts, which were much more convenient. This was the beginning of paper money, and the goldsmith's vault essentially became a primitive bank. As the town grew, the demand for credit increased. People needed loans to start businesses, build homes, and expand their farms. The goldsmith saw an opportunity to lend out some of his gold, charging interest for the service. Soon, borrowers began requesting loans not in gold coins but in the more convenient claim checks. This led the goldsmith to an intriguing realization. He had a lot of gold in his vault, but his depositors rarely came to withdraw it, and they certainly didn't all come at once. This meant he could lend out claim checks representing more gold than he actually had in reserve, creating new money without touching his own stockpile. The goldsmith's lending business boomed. He became wealthier than anyone else in town, earning interest on money he essentially conjured out of thin air. But as his wealth grew, so did the suspicions of his depositors. People began to wonder if he was using their gold for his own gain. Eventually, they confronted him, demanding an explanation for his newfound riches. The goldsmith, recognizing that he couldn't continue his scheme without their trust, agreed to share a portion of his profits with them in the form of interest on their deposits. This arrangement satisfied the depositors, and the goldsmith's lending business continued to thrive. However, the goldsmith's success attracted even more attention, and with it came increased risk. As word spread about his wealth, some depositors grew anxious. What if the goldsmith didn't have enough gold to cover all the claim checks he issued? Their fears grew, and rumors began to circulate. One day, a group of depositors demanded to withdraw their gold. This caused a panic, leading to a run on the bank. People flooded the streets, clamoring to get their gold out of the vault. The goldsmith, unable to meet the demand, had to close his doors. His scheme had collapsed, and his wealth vanished. The chaos from the bank run damaged public trust in the goldsmith, and other banks across the region suffered similar fates. To address the instability, the authorities decided to legalize the goldsmith's practice but with strict regulations. They established limits on how much fictional money a bank could create relative to its actual reserves. Central banks were also created to provide emergency support to local banks in case of runs, helping to stabilize the banking system and restore public confidence. Thus, the concept of fractional reserve banking was born. While it allowed banks to create money and stimulate economic growth, it also required careful oversight to prevent the kind of chaos caused by the goldsmith's unchecked greed. The lesson from The Goldsmith's Tale remains relevant. Banking can be a powerful force for good, but it requires transparency, regulation, and trust to ensure stability and prevent disaster. That's it for today's lesson. Remember to like and subscribe if you like it, and tell us what you want to hear for the next video in the comments.